short position for the shares of Unilever with a current share price of 5 cedis 89 pesos and a target fair price of 2 cedis 28 pesos, representing a potential downside of 61.3%. But sir, today we have a question for you, but we don't need our answer now, it comes later. Would you buy a company at a share price of 5 cedis 89 pesos, which is unprofitable, illiquid, uncompetitive, and highly indebted? This same company has no cash to even pay you dividend. On top of it all, it is the 36th among 39 other companies with respect to year-to-date performance on the Ghana Stock Exchange. Think about it, but we would want you to follow us through, and at the end of the presentation, we will have your answer. All right. This company we are talking about is no other company than Unilever Ghana. It is based in Ghana in the manufacturing of fast-moving consumer goods. It has three main segments: food, home care, and personal care, which all have seen growth, however, has resulted in net losses. Now let's have a look at the share price history. It's clearly here that Unilever is not volatile, and even when it was volatile, prices were constantly dropping. Now to our trading and operating summary. Unilever's price is now 5 cedis 89 pesos with a 52-week range of 2 cedis to 9 cedis 21 pesos. A market cap of 368 million, adjusted for debt and cash, arrives at total enterprise value of 389 million. Its 3-year revenue growth is negative 10.3%, and a gross margin for 2020 standing at 22.3%. EBIT margin for 2020 is negative 6.6%, and a 3 average EPS of negative 0.11. The free cash flow yield is negative 60%. This same company has negative return on assets, negative return on investment, and negative return on invested capital. Now let's explore more about Unilever. Unilever experienced volatile revenues for the past 3 years with a 5-year compound annual growth of negative 1.7%, evident from our revenues, so much inconsistencies. It also had lower gross margins due to increased costs, as can be seen from here. Unilever is not able to sell its products at a good margin, and we believe could further decline due to higher commodity prices and foreign exchange losses. Unilever experienced negative margins for the past 3 years, which saw a decline from 2017, so from 88 to 78 and then into the negatives. This company is indeed struggling to sell its products, as can be seen from the increase in brand and advertising expenses. All this makes Unilever a highly unprofitable business. I believe the question is still in mind. Now, the industry analysis with respect to the Michael Porter's 5 forces. We are saying that the power of suppliers is low because there are so many available suppliers, and also the switching cost with them is very low. The same with the power of buyers. So many buyers, distributed, supermarkets, consumers, etc. And there are also many of them unavailable at the same time with low switching costs. Now, with the competitive rivalry, we are saying it's high due to new products coming every day from the competitors alongside promotions. There are so many close substitutes with all their products, and the threat of new entry is high because people easily got in, and the HS would come from the approvals and legal by the legal and FDA approvals, as well as labor and supplies. Now we move to the market and economic analysis.
So looking at the market, the GSC composite index has seen a growth from the beginning of the year up to date, with a year-to-date change of 41.7%. Hence, it's showing that the market is really liquid. However, Unilever has been stable all this while and has been totally stagnant in the market since September. Unilever has not seen growth, as seen in our previous graph. Since September, Unilever has been stagnant and has not seen liquidity in the market. Looking at the economy is experiencing rapid growth, rebound from the COVID-19 pandemic. However, rising inflation and government debt will force the government to increase interest rate, hence making Unilever very tight to access loans from banks, which will cause their cost of goods sold to increase.
So we now turn on to. So let's now turn to why you should sell Unilever. Our first point is Unilever is a fundamentally low quality business, as can be seen from its financial statement for the last 3 years. When we examine growth for the last 12 months, it stood at 24%, and yet margins are down to 15.1%.
due to high increase in costs, which we believe is in fact going to increase due to increased commodity prices and the current energy prices going on in the world. We looked at, they are not just, it's not just the costs that is affecting their own profitability, but we look at the brand and marketing investment. Unilever is really struggling to sell its product at a margin. Look at their brand and investment. It increased from 7% to 8.7% in the last 12 months alone, giving the company negative EPS for the last 3 years. We move on to the next point. Unilever is highly illiquid. Looking at their debt to equity ratio, it has been increasing by double fold from 1.5 to 23.5 in just the last 12 months. What does this mean to you, the investor in this stock? It means the company is in fact struggling to make earnings, and yet the company has higher debt to pay. Even if it makes free cash flows, it's rather going to pay debt holders, not you, the equity holders. We moved on to say, even looking at the industry, Unilever is highly uncompetitive. Looking at Guinness, Ghana, and Fan Milk, looking at their share prices, Unilever is trading at a premium above the industry average of 4.17, giving it an enterprise value of 360 million cedis. But look at the 5-year revenue. It's been down by 1.7% as against industry average of 7.8, and even worse, the operating margin is down by negative 6.9 against the industry average of 21.5. And even worse, looking at all the multiples we have calculated, they are all negative due to their unprofitability. Now, how does all this factor in our valuations? These are our valuation assumptions. Unilever, we estimated the risk-free rate because we all know Ghana's debt has increased, and due to that, investors will require a default spread. So we said the 5-year bond is not risk-free. So to calculate the actual risk-free rate, we adjusted for the default spread, and we arrived at 13.1%. We measured beta by using the volatility of earnings for the past 5 years by calculating the standard deviation, and we arrived at an equity risk premium of 2.6, giving it a cost of equity of 15.6 and a cost of debt of 13.5, which would translate into a WACC of 15.3 and long-term growth rate of 3%. So our valuation models, as you can see, we have been very generous with Unilever. We are forecasting them to grow by double digits revenue in the next 3 years. And all our margins have been relatively higher than the previous 3 years. And yet, Unilever is still projected to make negative earnings, which implies you, the investor, will not receive any potential dividend in even the near future. Move on to the next slide. So, discounting all those free cash flows, we arrived at, we estimated terminal value using the perpetuity growth model to arrive at 192 million. Summing up all together, we arrive at an implied enterprise value of 163 million. Adjusted for cash and debt, we arrive at an implied share price of 2 cedis, 28 pesos, showing that Unilever is overly overvalued. In fact, using the WACC of industry average of 14, looking at the sensitivity analysis, we see that, in fact, the best they can have is just 4 cedis, 1 pesos. Now we turn on to our catalyst standards.
The catalyst number 1 is many related parties which are foreign. Unilever is heavily relying on many related parties which they import goods from, and that exchange losses is going to affect them. Coupled with the rising commodity prices and the global supply chain crisis, is going to make their cost of goods sold high. Also, talking about a rising inflation and public debt will force the government to increase their interest rate, which will put them in a tight position to access loans from banks to finance their working capital. Talking about our rates and metrics, number 1 is the interest rate, and then grace period that is given to them by their related parties. This period is just 1 year, which is 2021. By 2022, they will start demanding for payment from Unilever, and they are not going to be able to finance it.
Yeah, so the question we put before you, I believe now your answers are putting together, and indeed they are overvalued. As whether you are a value investor or a growth investor, you are neither targeting dividends or capital appreciation. So this is where we end. Thank you very much.
Thank you.
Thank you very much.